Ryan made $45,000 a year. He had just one credit card with a $5,000 limit. He wasn't reckless. He didn't buy luxury sports cars or expensive vacations. Yet, 5 years later, he found himself drowning in a massive $60,000 debt. And here's the absolute craziest part. Looking back at all his statements, he never once spent more than his five. So how on earth does a modest $5,000 limit secretly multiply into a life-destroying $60,000 in debt? Today we are pulling back the curtain on the silent mathematical trap that banks and credit card companies desperately hope you never figure out. Our story begins 5 years earlier. Ryan had just graduated college. Life felt full of possibilities, and his mailbox was stuffed with welcome letters. One envelope stood out. A shiny, premium-looking credit card with bold letters screaming, "No annual fee, free lifetime rewards." To a fresh graduate, it felt like a badge of financial adulthood. The bank representative smiled and gave him the golden rule that millions fall for. Just pay the minimum amount due each month and take care of the rest whenever you're comfortable. That simple sentence is ground zero for the trap. Let's look at the brutal math. When a bank tells you to just pay the minimum, they usually set it at a tiny 2% to 5% of your total monthly balance. If you owe $1,000, your minimum payment might only be $40. It feels painless, right? Wrong. The remaining 95% to 98% of your unpaid balance doesn't just sit there. It immediately gets slammed with an annual percentage rate ranging from 20% to 29%. Let's put that in perspective. Average mortgage rates hover around 7%. Standard personal bank loans sit around 10% to 12%. But credit cards? They routinely charge 25% to 29% plus. By absolute definition, credit card debt is the most expensive, predatory consumer debt on the planet. And Ryan walked right into the middle of it, completely unaware of what was coming next. Now, why do we fall for this? Because credit cards aren't just financial products, they are masterclass instruments of psychological engineering. Behavioral finance research reveals a fascinating, terrifying truth. Human beings spend 12% to 18% more money when paying with plastic or digital taps compared to physical cash. Think about it. When you pull out a physical bill from your wallet, you feel the pain, but when you tap a phone or swipe a sleek piece of plastic, there is zero physical friction, no pain, instant gratification. Banks wrap this in a glittering cloak of rewards points, 2% cashback offers, and buy now, pay later schemes. Every notification, every point milestone triggers a little hit of dopamine in your brain, pushing you deeper into a lifestyle you cannot actually afford to maintain. Let's return to Ryan. In his first month, caught up in the excitement of his new financial freedom, he accumulated $800 in everyday lifestyle expenses, dinners out, gas, groceries, and a few online gadgets. When the statement arrived, he didn't blink. He saw the minimum payment option, $40. Relieved, he paid the $40, thinking he handled it like a pro, completely missing the hidden danger. He didn't realize that the remaining $760 was now locked inside the bank's high-interest vault, waiting to compound against him. By month 2, the snow stopped rolling and started an avalanche. Ryan had his leftover $760 balance, plus his new monthly spending, plus the newly calculated compounding interest. The balance started creeping up aggressively, setting the stage for a financial disaster. Let's look at Ryan's terrifying multi-year timeline. Year 1. His balance crossed $4,000. It felt manageable. He figured a small raise at work would wipe it out. Year 2. Life happened, a minor medical emergency, some car repairs. He had to use the card more. The balance swelled to $12,000. The minimum payments now consumed half his monthly paycheck, leaving him stressed out and constantly searching for quick cash solutions. Year 3. The compounding monster woke up. At 28% APR, the interest alone was adding hundreds of dollars to his bill every single month before he even bought a single item of food. His debt hit $25,000. He started hiding statements from his family, pretending everything was fine while anxiety kept him awake every single night, staring at the ceiling. Year 5. The breaking point. Late fees piled up, penalty APRs kicked in because he missed a payment by one day, and his total liability skyrocketed to a staggering $60,000. Most people forget that compound interest is a double-edged sword. The exact same mathematical force that makes millionaires rich will violently crush you when applied to high-interest revolving credit card debt. And the damage didn't stop in his bank account. Ryan's credit score plummeted from an excellent 750 down into the warning zone. Landlords rejected his apartment lease applications, auto insurance rates went up, and background checks for potential new jobs flagged his financial distress, making it nearly impossible for him to climb out of the corporate hole he was trapped in. It was a rainy Tuesday night when Ryan finally broke down, pulled out his calculator, and did the shocking math. He realized that the total cumulative interest he had paid over 5 years to the bank could have bought him a brand new, reliable car entirely in cash. That moment of brutal clarity became his turning point. He realized he needed an aggressive battle plan to reclaim his life. If you are finding yourself in a similar position, here are the exact 4 steps Ryan used to fight back. 1. Stop making the minimum payment strategy. Recognize that paying only the minimum is a mathematical trap designed to keep you in debt for decades. You must pivot immediately to paying in full, or throwing every extra dollar you earn at the principal balance to kill the interest loop. 2. Deploy the debt avalanche method. List all your debts by interest rate. Attack the highest interest debt first with maximum aggression while paying the minimums on everything else. This stops the bleeding where it hurts the most. 3. Freeze, don't cancel. Do not close old credit card accounts because it hurts your credit score length. Instead, freeze the physical card in water. 4. Leverage balance transfers or low-interest personal loans. Move high-interest debt over to a 0% introductory APR balance transfer card or a lower-interest fixed personal loan, immediately cutting off the daily interest hemorrhage that drains your monthly earnings before you even get a chance to save a single dollar for your future goals. It wasn't easy. It required massive lifestyle adjustments, cutting out non-essentials, and strict budgeting. But exactly 18 months after executing his brutal payoff plan, Ryan logged into his app one final time. The balance read, 0 dien, 0 does. The weight of the world finally lifted off his shoulders, and he could finally breathe easy again. And here is the ultimate takeaway from Ryan's journey. Credit cards themselves are not inherently evil. They are simply powerful tools. A hammer can be used to build a beautiful family home, or it can be used to break a window. The true villain isn't the plastic card in your pocket. It is the financial illiteracy and a corporate system engineered to silently profit from your lack of awareness. Master the tool, understand the math, and never let a piece of plastic control your future. Make the card work for you. Do not spend your life working to pay off the card. If you are carrying credit card debt right now, you are not alone, and there is a way out. Drop the exact words minimum payment in the comments below right now. In our next video, I will break down a complete, step-by-step, debt-free payoff roadmap. Hit that like button so this video can push through the algorithm and reach someone who desperately needs to see it today. Thank you for watching, and I'll see you in the next one. Take care of your health and your finances.